38% yield, paid out weekly. That's what we're seeing with this Roundhill QDTE ETF, and I gotta say, that's pretty enticing. Weekly payouts, kind of like a paycheck. Who wouldn't want that? Especially these days.
Yeah, no, it definitely grabs your attention,
Yeah.
right? But as seasoned investors, and I'm assuming most of our listeners are, we got to remember that flashy number doesn't always tell the whole story,
Hmm.
especially when something sounds almost too good to be true. Often is.
Right, right. So let's dig into this. So QDTE, it invests in the Nasdaq 100, but with a unique spin. They've got this strategy they call the zero DTE covered call strategy, and instead of just buying the stocks outright, they're playing in the options market. And we're not just talking any options; we're talking about ones that expire on the same day.
Yeah, it's definitely a bolder approach. I think a good way to think about it is imagine you want to profit from a house going up in value,
Yeah.
right? So you could buy the house, but that's obviously, you know, that's a big upfront cost. You got to sink a lot of money in. What QDT is doing is more like they're renting a room in that house and they're doing it daily. So they get some of that exposure to those price increases, right? If the house value goes up, they benefit, but they also have way less control and there's that risk, they could lose their rent money if things go south.
So they're basically making a bet, a very short-term bet on the Nasdaq. They're trying to ride those daily, even hourly swings.
Yeah, exactly. They're really trying to capitalize on this idea of overnight volatility,
Mhm.
which is essentially how markets just tend to be a lot less predictable outside of regular trading hours. And we've seen some historical data that suggests it can be a profitable strategy,
Mhm.
but there's always a but, right? It definitely increases the risk. One of the articles we looked at actually compared this to picking up pennies in front of a steamroller.
Yeah.
You might you might snag a few pennies, but one wrong move and
Yeah. Game over.
exactly.
Okay. So we've got this daily gamble essentially, but then there's this other layer to it. And forgive me if I sound like I'm not up on the lingo here, but there was this phrase, poor man's covered call. I don't even know what that means.
Yeah, no, it's a bit of a misnomer. Basically, instead of owning the stocks in the Nasdaq 100, they're buying these call options. But these aren't just any call options. They're what they call deeply in the money call options. And that gives them the right, but not the requirement, to buy those stocks at a price they set ahead of time. Kind of like, instead of buying that room we were talking about, putting a down payment on it. So you're invested, but you haven't gone all in.
So they're using leverage, but they're not really using leverage.
In a way. Yeah, it's like they're trying to amplify their potential returns by using these options, but, and this is the important part, it also amplifies their losses if things don't go their way.
Right.
Because they're not just exposed to the Nasdaq 100 going up or down, but how fast and how much it moves.
It's kind of like they chose to enter a speedboat in a race where everyone else has a yacht. So yeah, they're nimble, they can move fast, but if a storm hits, they're much more likely to get completely wiped out. So how has this risky strategy been performing?
So initially, it seems like they were defying gravity. I mean, for a period, they actually outperformed the Nasdaq 100 in terms of total returns.
Hmm.
But, and this is really important, we have to be careful not to confuse total return with price appreciation. They're two different beasts.
Right, right. Like earning, I don't know, a bonus at work versus getting a massive inheritance. They both put money in your pocket, but one is not exactly a sustainable long-term plan.
A perfect analogy.
Yeah.
Because while QDTE has been, spitting out these attractive dividends, the share price itself has actually been dropping. It's kind of like they're taking a little bit out of your principal every month and giving it back to you, disguised as this dividend.
Sneaky, sneaky. Although, to be fair, we did look at some other similar ETFs that also use covered call strategies, things like QQQY and JEPY, and guess what? They were also down. And some of them even had slightly higher total returns than QDTE. So clearly this is a trend. This high-risk, high-reward approach seems to be all the rage in this corner of the market.
It is a trend. And it's one that I think really requires careful consideration, especially for investors who might be relying on those dividends for income, because and one article really highlighted this, those payouts aren't guaranteed.
Okay, so we're starting to see the cracks in the seemingly perfect high yield picture. But before we completely write off QDTE, let's dive into maybe some of the potential pitfalls and see if there are any scenarios where it actually might make sense. So we've established that QDT strategy is, well, it's a wild ride, like buckle up, hold on tight kind of stuff. But is it inherently flawed or just maybe
Well,
misunderstood?
that's the million-dollar question, right? And
Mm.
one of the, I think, the biggest concerns with QDTE, or really any fund that's so heavily reliant on options, is this idea of a yield trap.
You'll track. Okay, yeah. That doesn't sound good. Can you break that down for us, non-finance folks? What does that even mean?
Sure. Imagine you stumble upon this beautiful orchard, right? It's overflowing with ripe fruit, and so you're happily filling up your basket. But then you start to notice that the trees themselves, they look a little worse for wear. They're kind of withering, and it dawns on you that pretty soon there just aren't going to be any more fruit left. That's essentially what a yield trap is. And with QDTE, the worry is that while the dividends might seem juicy now, the underlying asset, the Nasdaq 100, it could decline in value to the point where it really jeopardizes those future payouts.
So it's like getting a really generous allowance, but it's coming out of a piggy bank that's never getting refilled. Eventually, that money's gonna run out.
Exactly. Now, in fairness to QDTE, they're not completely ignoring this risk,
Mm.
but they have built in some safeguards, mainly by selling their zero DTE options slightly out of the money.
Hold on. Out of the money. I thought we were done with the jargon. What does that one mean?
Right, right. Sorry about that. Basically, it means they're sacrificing some potential for huge gains if the market were to skyrocket overnight. And in return, they're getting slightly lower, but ideally more consistent income. Think of it, I don't know, like choosing a guaranteed bonus at work over a riskier commission-based structure.
So they're playing it a little bit safer, hoping for consistency instead of trying to hit home runs every time. But even with that, doesn't the fact that their whole strategy hinges on these daily market movements, doesn't that just make them incredibly vulnerable? The market is anything but predictable.
You're absolutely right. And one article actually argued that while this strategy could work out well in a sideways market, where the Nasdaq isn't making these huge swings, the minute you get volatility, it's like their Achilles heel. Any kind of sudden sharp downturn, it could wipe out weeks or even months of those
Hmm.
premium gains they made.
It's like building a house of cards on top of a washing machine. You might get a couple of levels high, but one good spin cycle and that's it.
Exactly. And this isn't just, a hypothetical risk. I mean, we have seen periods recently where the Nasdaq 100 has been incredibly volatile. And for investors who are, maybe approaching retirement or are in retirement, who might be depending on those payouts for income, that kind of uncertainty can be, well, incredibly stressful.
Yeah, it's like planning your monthly budget around a friend who might pay you back for that concert ticket you bought them.
Right. Makes it very hard to plan for the future. And this actually brings up another criticism that we saw leveled at QDTE. Some analysts were saying that this strategy, while it sounds, fancy with zero DTE and all that, it's
Yeah.
it's really not that innovative.
Oh, so you're saying these zero DTE covered calls are more smoke and mirrors than a revolutionary new approach.
That's what some people are saying.
Yeah.
Yeah. The argument is that it's basically a more complicated and arguably riskier version of just a traditional covered call strategy. Plus, you've got the added trading costs that come with doing so many trades every single day.
So potentially less efficient and more vulnerable to market swings. It's like they're trying to reinvent the wheel, but they made it square.
And those square wheels come with an expense ratio of 0.95%, which, in the ETF world, that's not nothing.
That's a pretty hefty price tag. So not only do you have the inherent risk of the strategy itself, but then you're also losing a chunk of your potential gains just to fees.
Yeah, that's right. And that's not even factoring in taxes on those distributions. So it's really important to keep all that in mind when you're comparing QDTE to other things you could be investing in.
It's like paying extra for front row seats to a baseball game when there's a good chance it's going to get rained out. Speaking of other options, before we get too deep down the QDTE rabbit hole here, what are some other ways investors can dip their toes into these high yield waters? If they like the idea of covered call strategies, but maybe they're not quite ready to hop on this QDTE roller coaster.
Okay, so we've gone deep into this QDTE thing, and I think it's safe to say it's not for the faint of heart. But before we completely swear off high yield ETFs, what are some other options out there? For investors who like the idea of covered calls, but maybe aren't quite ready to jump out of a perfectly good airplane, so to speak.
Right. It's like you like the idea of skydiving, but maybe you'll start with a nice hot air balloon ride first. There are plenty of ETFs out there that use covered calls, but they do it on a monthly or even a quarterly basis. So yeah, they might not have those eye-popping yields that QDTE is boasting, but they also tend to be a lot less volatile. So it can be a much smoother ride for your investment.
Yeah. A little less, will my money survive the night? And a little more set it and forget it.
Exactly. And ultimately it really comes down to, what's your risk tolerance? What are your goals? If you're someone who really prioritizes that reliable income stream, there are other avenues you can explore too, like dividend focused ETFs, for example. They invest in companies with a track record of paying dividends,
Yeah.
but not just paying them, but actually growing those dividends over time.
Yeah. The dividend aristocrats, they might not have that same get rich quick appeal that maybe QDTE does, but they offer something that's arguably a lot more valuable, and that's stability. It's predictability. It's like the difference between a flashy sports car and a reliable family sedan. They'll both get you where you need to go. But one of them is probably going to offer you a much smoother, more predictable ride, especially if you're going on a long road trip.
I like that analogy. And let's not forget about REITs. Real estate investment trusts. If you're looking for some diversification and some passive income, they can be a good option to at least consider. Because REITs, they're actually required to distribute a big chunk of their profits as dividends. So
Right. Yeah, REITs are like that friend who always insists on splitting the bill evenly, even when they order the most expensive thing on the menu. You always know where you stand with them. It's usually a pleasant surprise when those dividends come around.
exactly. They can be a really nice addition to a balanced portfolio. But I think, as we kind of wrap up this deep dive on high yield investments, I think the big takeaway here is there's really no such thing as high reward without at least some risk. And don't get blinded by the flashy numbers, the attention grabbing headline.
Like they say, if it seems too good to be true.
It probably is, exactly.
Yeah.
And often those high yields, they come hand in hand with higher risk. So, before you go all in on any investment, but especially, something like QDTE, where it's complex, it's potentially volatile, do your homework. Read those prospectuses, really try to understand how the strategy works. And most importantly, make sure that it really aligns with your risk tolerance, your goals, your time horizon.
Couldn't agree more. Proceed with caution and an educated mind, everybody. Well, on that note, I think we've probably scared everyone away from ever investing again.
Hopefully not.
Hopefully not. But that is going to do it for this deep dive. We hope this has been helpful, that you've learned a thing or two. And until next time, happy investing, everyone.